So good morning, ladies and gentlemen, and welcome to the next webinar. This particular webinar is focused on adult specialist care, and really because the impact of coronavirus has been dramatically different on adult specialist care compared to other sectors of social care. And it's really proven its position as a key part of the social care infrastructure in its resilience and its ability to flex its model in the face of coronavirus. My name is Henry Elphig. I'm the Chief Executive of Languisson, and I'm delighted we've got a fantastic panel today joining us to discuss the sector. And we're also delighted that Grant Thornton has partnered with us for this particular webinar and are also sponsoring the Languisson Adult Specialist Care Market Report, which will come out in a couple of weeks' time and will be informed by the discussion that we have today. We're also continuing to support the Care Workers charity and Turn to Us. These are two charities which are very much helping the sector. The Care Workers charity has raised £1 million since the start of the pandemic, and Turn to Us has raised over 2 million with the assistance of the Daily Telegraph that made it its named charity over the last few weeks. And both of them are helping care workers across the sector who are in need, dispensing small grants around £500 to help them if they're self-isolating, for example, or they need help with their families. And our media partner is Care Markets, which is available online. There's a coronavirus toolkit on the Languisson website with free headlines and links to useful sources of information for a wide variety of topics. So please feel free to look at those. We're going to start by really just explaining the market map and where adult social care, what we're going to talk about today, fits into the broader landscape. As you can see from this, housing, healthcare and children's social care are key parts of the infrastructure that runs across the whole of health and social care. But the part of the market we're focused on today is essentially a subsegment of adult residential social care services. So we are not looking at care homes for older people, we're looking at young adults and principally young adults with learning disabilities and mental health. And we are also going to reference some of the elements around supported living, which we covered a little bit in our last webinar, simply because the services that are delivered are very, very similar between the two, albeit that the housing component is different. As part of the invitation that went out to everybody, we asked people to pose questions, and there were some themes that came out of the questions that we got from you. Just to run through a few of them. How many providers will go out of business if they don't receive a government bailout? And I think there are a number of particularly not-for-profit providers who have low levels of profitability or indeed lose money normally, who are particularly exposed. Where will fees for specialist services go post-COVID? Will contracts ever be at the right price? I think this is particularly important because we know that the government is running up significant deficits and everybody is going to want to have money post-COVID for very valid reasons. So it's going to be a case of having to justify the fees that people receive on a relative rather than absolute basis increasingly. What is the experience of providers in getting local authorities to compensate for additional costs? Have providers been given any feedback in terms of how they manage their service users around things like social distancing, which can often be very challenging with people with learning disabilities? And how damaging financially has COVID been in relation to the extra costs for bank staff, for example, and some of the new money that's been announced by Boris Johnson, the £600 million yesterday, will any of that trickle through to adult specialist care? So I think some pretty clear themes there in terms of some of the immediate challenges in the sector and also the outlook more generally. So again, as in our previous webinars, we're going to use Slido as the tool to manage the questions and also the polling. So if you have a laptop, a tablet, a smartphone, or just a separate screen on the computer you're on at the moment, if you open up the browser and just go to slido.com, it will come up with a screen with a box with a hashtag in. And all you need to do is put in ASC for adult social care. And that should take you to a page which allows you to ask questions and also participate in the polls. And if you ask those questions, you can do so by putting your name in, or you could do so anonymously if you wish. But the other key thing is you're able to upvote the questions that you see for the ones that you would like the panel to address. And that helps us triage it. We often get hundreds of questions. So in order to answer the most relevant ones for the audience, it allows us to identify them if you just upvote them. So the key test of this is I'm going to run a poll, and this will allow us to see how many of you have logged in. And I can see that already over 20 of you and climbing have managed to log in for the poll. So the question on the poll is, what is the biggest headwind for adult social care? Is it maintaining sector profitability? Is it fighting for funding? Is it higher costs, so managing those increased PPE costs, staff, compliance? Or is it clarity on sleep-ins, which is still potentially a very large liability? It's not clear where the Supreme Court will go. And hopefully it comes up with a sensible answer. But I think with all these legal processes, there is an element of risk that it goes the wrong way. So we will let that run. You're also able to submit questions. I'll just click over to the questions, and you can see those are some of the questions that have been submitted. And you can see the voting there. So 3 people have voted for that first question. So we'll let that run in the background. So if I go back to the presentation, at the moment we have a home care and supported living report, which is available online. That came out very recently. And as I said, the information from this webinar will be used to inform our adult social care report. And to help us do that, we actually have a fantastic panel. We've got William Lang, who's the author of that adult social care report, who will set the scene and give you some data on the market. We then have John Whitehead, the CEO of Exemplar Healthcare, which is one of the outstanding providers in the sector from a perspective of quality, some very impressive metrics. Mitesh Danak, who's the chairman and founder of Precious Homes, which again has some very high quality metrics and is treating some of the most acute service users in the sector. And Steve Scown, who's the CEO of Dimensions, which is a very significant not-for-profit provider, which is active actually across the market in a number of different segments, and is also very much a scale provider. And then finally, Peter Jennings, who's a partner at Grant Thornton, who will put this in perspective once we've heard from the providers in terms of what's happening in the market, particularly from an investor perspective. So on that note, I will hand over to William to take us through effectively an overview of the market itself. William.
Thank you, Henry, and good morning, everyone. So what I'm going to do is to run through a number of slides, just giving an idea of the scale of the market. And I think there might be a previous slide before that one, is there?
I think that's the first one, William, I'm afraid.
If not, fine, okay. So first of all, just the value of the market by client type, and the overall value in England, we estimated £10.5 billion a year. This is from 2019. And in the for UK, if you extrapolate to the UK, then you'll get to a figure of 12.7 billion. And as you can see there, the biggest, as Henry says, the biggest client type is learning disabilities, followed by physical disabilities and mental health needs. So let's go on to the next slide, if we could, which shows the value by support setting. So here we have the biggest still is services in residential settings at £4.3 billion. And then the supported living element is 1.5, 1.6 billion pounds. Again, the same totals for the market in England and the UK, 10.5 and 12.7. So if now we go on to the next one, and we do this by funding source, so that unlike the older care sector, where there's a large private pay element. The private pay element is pretty small in the case of adult specialist care, to below £500 million a year. And the biggest part of it is, of course, local authority commissioned. And then there's quite a significant chunk for direct payments, where local authorities are providing the service users with cash they can pay for their own services with. And then quite a substantial element still for the NHS, which does quite a lot of joint funding with local authorities. So let's go on to the next one. And this is something which has been happening for several years. I have to say that the data here are not terribly good, because we're not well served with data from official sources, from NHS Digital, on how many people are receiving services. The one we're most certain about is the plum area at the bottom, which shows the number of people in residential care, which we record pretty well, and we know that those numbers have been slowly declining over the years. And in fact, it doesn't appear there, but the CAGR, the compound annual growth rate, is negative. It's -3% a year over that period. But if you look at the top, and you see that the total CAGR in terms of numbers of individuals receiving services is +2%. So what this means essentially is that there's a slow shift which is continuing from residential care to non-residential care, and primarily to supported living, because the supported living cost per person is significantly higher than the others. So that's what's happening, continuing in the background. And now just moving on to sector profitability. What we see is that there's been a significant decrease in profitability for the sector as a whole in the years post-recession, in the austerity years, and quite a lot of variation amongst different organisations. You have to distinguish here between the for-profits and the not-for-profits, and not-for-profits tend to operate, or in fact deliberately operate, at low margins. In fact, the best example of this is the one at the bottom, which is
Leonard Cheshire,
which funds a lot of its work from its charitable donations, and has a very, very low, negative profitability. And so let's move on to the next one. It's just a few questions here. It's to do with additional costs due to coronavirus. What we're pretty sure of is that the adult specialist care sector has been relatively protected from cost pressures compared with the older care sector, and because of the service user characteristics and because of different sort of staff interactions. And the main cost areas in older people's homes is PPE and deep clean, payroll, sick pay, overtime agency, and then net loss of revenue from occupancy reduction, with a lot of deaths and slower new admissions. So the question is, how far does this apply in the adult specialist care, and what magnitude of extra costs are we going to see? So I'll be interested in hearing the discussion and feedback. So that's me, so I'll hand on to the next one.
Thank you very much indeed, William, for that. I am delighted to pass the baton on to John Whitehead, who's the CEO of Exemplar Healthcare. And I think the first slide is also quite helpful in giving a little bit of background on Exemplar for those on the webinar who perhaps are not aware of the business. Over to you, John.
Thank you, Henry. Good morning, everybody. I'm guessing, looking at how many of you have joined this webinar, that Boris's offer of unlimited exercise has not tempted you all away from your laptops. Looking at the weather, that's one hell of a temptation. So I joined Exemplar in 2017, following a number of years working in a different part of the industry, namely domiciliary care. So you could say I've experienced two very different sectors with very different pressures. I've effectively swapped managing 20,000 mobile carers, tending to people in their own homes, 3,500 staff looking after our service users in our homes. So I can look at the current pandemic through different lenses, I guess, but for this morning, I'll come at this from an exemplar perspective for young adults care. By the way, in case you're not aware, an average age of 56. Our service users are referred to technically as young adults, which is why I like to work for Exemplar. Could I have the next slide, please, Henry? So what does Exemplar do? Well, we operate homes from Birmingham to Hull and across to Liverpool, 31 homes across the centre of England with currently 860 bedrooms, and we work with 101 funders comprising CCGs and local authorities. Exemplar started 20 years ago, and we grew our homes last year by 20% and will continue to do that at least at that pace for the foreseeable future. Our primary focus, as I'm sure my fellow presenters will resonate, is and always will be the quality of our service users' lives. Everything else falls into place after that, as hopefully you can see on these key performance indicators. And I'm pleased to say that currently 10% of our homes are rated outstanding by the CQC. Next slide, please. So re-COVID, on the 29th of March, our first case of COVID was detected at one of our homes in Sheffield. I went straight over there the next day and met with the management team. What I saw and experienced really set out the stall for what was to come. Staff were calm and pragmatic. The virus had entered the home, but their total focus was to protect and care for our residents. And so 2 months later, I can share with you some statistics. Sadly, first and foremost, across the company, just over 2% of our service users have passed away with confirmed coronavirus, or 8% of the cases arising. However, this is clearly well below some of the levels being experienced in other parts of our sector, as has been reported. Regarding PPE, we've managed to provide continuous and ample supplies of all PPE to our staff since the outset, sourced almost totally by ourselves, however, and not the NHS. And absence levels over the group due to coronavirus has never really exceeded 7-8%, and most of this was attributable to early unease, the well-worried, as they call them. It's now returned to far lower than normal levels of absence at just over 1% as of today. Fortunately, coming into this virus, Exemplar was in a pretty good place, qualitatively and financially sound. That this leads to greater tenure, lower attrition. So we had amazing staff resilience, loyalty and morale, enabled us to take swift investment decisions, which we had to. And those who've run these businesses in this outbreak, you know, we were talking about making decisions in hours, minutes and hours, and particularly around PPE, to protect our staff and service users. We didn't get everything right. After all, there are no rehearsals for this. But overall, I think we've weathered this first storm, and maybe there'll be more phases to come, but the first storm we've weathered, and largely at the moment, it's business as usual going forward, and our admission rates have remained pretty stable and constant going forward. The next slide, please. So looking ahead, and considering whether the question really is whether coronavirus will cause a paradigm shift in how social care is delivered, I have to say, at the moment, I don't think so. The issues are clearly very complex and impact differently, as Henry mentioned, in different sectors. And as I well know, having worked in domiciliary care and now moved into high acuity specialist care. This has been a hot and urgent government topic for around 20 years at least now, through successive governments, moving from free personal care ideas to the so-called dementia tax, from the sort of Scarlet Pimpernel of all papers, the green paper, to a possible white paper. So low acuity care provision will continue, I feel, to be commoditized. And so long as service providers continue to clear minimum quality care hurdles at stripped to the bone prices, and this outbreak doesn't directly impact on this arrangement. For specialist young adult care like ours at Exemplar, the care can't be commoditized. It's bespoke and it's tailored individually to service user by service user. Here the question really is clinical, not financial. What is the care plan that will maximize a person's quality of life? It's not negotiable, and you can't cut corners here. Sadly, around 60% of all our service users come to us eventually following failed placements elsewhere. And that's the point. Our service users, along with their family and authority links, have a voice, and the funders listen. It's not about price. Inadequate levels of high quality care at our level of service security just won't work. They don't work. So once again, I think COVID will create a limited shock to our sector, but I don't think it will create a seismic shift in the current arrangement. And finally, and just before I finish and pass over back to you, Henry, I know we've got some Exemplar employees who are watching this, so a huge thank you once again for everyone. You're doing a great job. Over to you, Henry.
Thank you very much indeed, John. And I think, just a takeaway there from what you've said, you've got quite a unique perspective. And as much as you said at the beginning, you've worked in the home care market where people are on wafer thin margins, and it is the lower level of acuity and more commoditized. So I think that my takeaway from what you said is actually COVID for adult specialist care may in fact accelerate that difference between high levels of acuity which are paid for and funded, and an increased level of commoditization and a desire to push people out into potentially other lower cost settings at the lower end. So we're going to have to make some tough choices from a funding perspective over the next few years. And I think what I'm hearing is that actually, if you were looking at the market, you will see a shift towards focusing those most vulnerable and most in need, and perhaps people being more choosy in terms of how they fund those who are not necessarily high up that acuity scale, which may or may not be a good result, but I think that looks like it could be the direction of travel. So on that note, I'm delighted to invite Mitesh to tell us what is going on at Precious Homes and the impact that COVID has had on his business. Mitesh, over to you.
Hi, good morning, everyone. So I've basically split it into sort of 4 areas within the business. Our people, and I've split that down further into our service users and our team members. The dreaded PPE, our processes and our performance, and how these areas were impacted by COVID. By way of background, Precious Homes operates about 40 services from Birmingham down to London. We work with people with severe challenging, who present with severe challenging behavior, and we work in both residential care and supported living. In terms of our service users, we're very fortunate, actually. So far, no one has been impacted by COVID-19. They're all in good health. So what do we put that down to? Is it the fantastic care at Precious Homes? Well, might be an element, but I don't think that's the real answer. I think primarily it's the demographic. Quite a lot of our service users are much younger. And in fact, our sort of average age is probably in the late 20s. The other reason why I feel our services aren't impacted as much is because our settings are very much self-contained flats. So again, there's not many people sort of going and sharing environments, which reduces infection rates. And also, our units are much smaller, and the average size is around 8 bedded units. So again, less people, so it just reduces further the risk of infection. The other impact on our service users clearly is on their routines. So, we're working actively for our service users to be going into the community every day. Now we're having to say to them, sorry guys, you have to stay in. It was difficult at the beginning with social stories and skilled intervention by our MDT teams and the frontline staff. Again, we managed to keep that controlled, and no big peak in sort of behaviors there. One of the interesting sort of upsides of all this has been that the volume of visitors coming into our homes has reduced as a result of lockdown. So no families attending, no professionals or social workers visiting. So the actual environment within the homes is actually much calmer and quieter. And a number of our residents have actually enjoyed that. So it's actually, something has come out of it, which has been positive, which was interesting. In terms of the impact on our frontline staff members, Well, as we've seen throughout in the news and all of you have experienced, no doubt, absolutely fantastic staff teams we've got who've really stepped up and who've been really creative and innovative. And it's just amazing how they've really kept life as normal as possible for the people we support. It's just incredible, and I'm really blown away by that. In fact, I'm very humbled that people have been coming into work every day, putting themselves and their families at harm's way, but still doing that. So it's just really, really incredible. One of the concerns we had was around the staff well-being and just the anxiety and mental health with people having to come to work with this sort of COVID cloud sort of hanging over them. So what we did do was increased our communication with the teams. So in terms of face-to-face communication, in terms of check-in calls, and also we had like a weekly memo that went out to all the staff members. And the central messaging there was very much, together we'll get through this. And then we'd just keep them updated on the latest government advice, our PPE stocks, reassuring them that the company was financially robust and that their jobs are really secure, they don't have to worry about that. And also signposting them on other sort of resources, both internally and externally, in terms of places where they can call to get some support. So that's actually worked out quite well, and I think that's helped with the staff morale a bit. In terms of sickness levels, again, we're very fortunate. The demographic of our staff teams is a lot younger, and that has meant, again, the impact of COVID hasn't been very significant. So, as John said, at the beginning there was a peak, but that quickly came down, and now our sickness levels are almost back to normal. In terms of our central support teams, we obviously had to shut down literally within a day. Where we were lucky was we were looking at going into hot desking just before the epidemic started. So most of our teams already had laptops. And as luck would have it, we just recruited an IT manager who joined us in February. So that sort of transition of working from home happened not with huge amounts of glitches, and it was pretty all right in the end. And similarly, our investment in technology in terms of cloud-based care planning systems and HR systems meant accessing them whilst working from home was pretty easy and straightforward. So that whole sort of transition to move away to work from home went pretty well for us. The dreaded PPE. So the government guidance here is very much based around elder care. So it's basically the challenge is sort of navigating your way through that, which has been a bit of a challenge. But we've had, providers have sort of sought advice from each other, and Care England has obviously stepped up and given us their view on it, and we've kind of like sort of navigated our way through that. The challenge obviously has been some of our service users not wanting to wear masks and how you work with that. But again, with social stories, it's kind of like they're beginning to accept it, and it's working reasonably okay. The major sort of impact of PPEs is the cost and sourcing and the challenges around that. But again, we've managed to sort of find enough stocks and keep going. So it hasn't been a huge challenge for us. In terms of our processes, the big ones that we had to change was our recruitment and our induction processes. We used to have assessment days where we'd invite lots of people on one day and carry out assessments in a group. So we couldn't do that anymore. And our classroom inductions, again, we couldn't do them anymore with social distancing. But we were lucky in terms of being savvy with technology and with our new IT manager that we brought these systems online, and that seemed to work pretty well. So the final bit, performance. As I said previously, none of our services were impacted by COVID. So our top line has remained pretty resilient. The PP cost is one of the major impacts of the pandemic for us in terms of our performance. And we're hoping some of the local authorities may be paying some of the money towards that, but we wait and see. The other impact is business development function. We've not managed to get admissions in, which were confirmed, although that has sort of loosened up a bit, and we did have one admission this week. Similarly, in terms of trying to carry out assessments on potential referrals, we haven't managed to quite do that yet, but I think that's changing. So all in all, it's been pretty resilient, and we've been very fortunate that our demographic, both in terms of our service users and our staff members, being younger, has certainly helped us through this pandemic. Next slide, please. So in terms of the world post-COVID for us, one of the things I really want to do is help, and really raise the profile of the social care sector and its talented workforce. So I've been involved in a campaign called Sparkle for Care, and I just want to do more sort of initiatives like that, so that these people are not looked at as low-skilled workers going forward. We're certainly going to be embracing technology and encouraging more work from home. I've certainly enjoyed it and found it, that you don't have to go to work every day, and you don't have to do that commute every day. So we're certainly going to look at doing more of that. I think our weekly communication with the teams has been very successful. So we're really going to continue with that going forward. And finally, just look at all the lessons learned from this pandemic, and just see what else we want to do. What do we want to take from this going forward in our processes and how we work. So yeah, that's it from me.
Mitesh, thank you very much indeed for that. I think a couple of things that certainly struck me there. First is just the levels of admissions that people are seeing, and maybe we can circle back at the end as well to John, but Steve, if you're able to address that, because I clearly that's all part of rebooting the economy, is getting things flowing again and getting new admissions in, and the challenges of doing that in the face of a pandemic where you need to assess somebody on a one-on-one basis. I think the second thing is just it seems to me there's a dramatic difference in the prevalence of COVID depending on the setting. So we saw in one of our earlier home care webinars that actually the COVID is virtually not present in the home care market. It sounds like it is virtually not present in the smaller settings within adult specialist care, those 6 to 8 bed facilities. We heard from John that one of his facilities had it, but I think, John, you have slightly larger facilities, sort of 40 beds or so. If I just unmute you just to confirm that.
Yeah, that was a home with over 60 beds.
Yeah, so that in some ways is also very consistent with what we're seeing in elderly care, where the average size of home is sort of 50, 60 beds. So having those bigger institutional settings just naturally raises your risk profile. So I think on that, I'm delighted to turn over to Steve Scown. And Steve, I think you're in a unique position because you've got actually a really broad breadth of services, both in terms of the services themselves, but also geographically. And just to flag up on the questions, we were having lots of people asking, well, let's not talk just about England, what about Wales and Scotland? So I think it'd be really interesting to hear your perspective as well. So over to you.
Okay, thank you, Henry. Good morning, everyone. I'll try and address those points. Dimensions, not-for-profit provider of services for adults with learning disabilities and autism, working with 92 local authorities in England and Wales, providing residential care, group living services, supported living services. I'll try and address some of those points. I think I read an interesting quote the other day. Never before in history has every leader in the world had the same issue on their agenda. And I think that pretty much sums up where we are today. So I wanted to start my 5 minutes on leadership. And I think it's been really interesting to notice how differently our local authority commissioners have been behaving. I mean, early on, I saw the LGA guidance note and I was perhaps naively hopeful. Well, I'm pleased to say of our 92 commissioners, 60 have responded positively to our request for additional funding. So at the moment, to date, we've had £900,000 worth of additional support committed by local authorities. Clearly, we're going to have to account for it at some point in the future. Some of those, that's a one-off grant, where we'll be going back to them, clearly. Others, that's up until June, etc., etc. So we've got 32 outstanding, and we're chasing those now. I think most of that's been grant based upon our turnover. But there are some pedantic bureaucrats emerging. The worst local authority I won't name on this programme is a local authority which is requiring us to fill out a spreadsheet detailing mask usage and provide copies of their invoices, which we're not going to do. Next slide, please. Okay, it's incredibly noisy, and I think at the top of it, facts are stubborn things, statistics are pliable. I was really interesting looking at the BBC Breakfast this morning. I see there was a really interesting item around about 8:10. If you want to look at it on iPlayer, around data, and NHS England are supposedly producing some information today about death rates in NHS-funded environments. CQC have again issued some guidance, but the problem is that each of those data slices is just part of the overall picture. So it's really hard to get our handle on what's really happening. I found it really interesting listening to John and Mitesh, hearing about their experiences. So 8 weeks in, we're still grappling with the information. I mean, I never thought I would see a report talking about social care worker death rates, and I think that's a very sobering moment, which will, I hope, shape the public's perception of the importance of social care moving forward. I'm probably slightly naively, perhaps a little bit more optimistic than John, but we can but hope. So in terms of what's been happening in Dimensions, we support 3,500 people in various different settings. We've had 103 showing symptoms. Of those groups, 25 have been admitted to hospital and have had a positive test, and we've had 9 deaths. A third of those deaths were people already in hospital for general health related reasons, and they contracted it in hospital. The lockdown was interesting. We have very small services, so we have our care homes are usually 6 beds or less, or supported living services similar. So I do think the size of units will emerge as a factor in the levels of risk for people. Got to remember that 40% of state-funded people with learning disabilities die of a pulmonary death in a normal year. So I think that, for me, highlights the risk profile of this group of people that we provide care and support for. Next slide, please, Henry. Thank you. So I just want to finish on forwards or backwards. So is the system going to go forward? So if it goes backwards, are we going to see more pedantic bureaucrats strangling innovation and strangling providers requiring spreadsheets for this, that and the other? Are we going to see further expansion of large units? Are the Care Act easements going to become the norm? Are the politicians finally going to get a grip of this? Or if we go forward, are we going to see a bit of a political consensus and a commitment to a progressive policy agenda? Will social care be a valuable part of society? Are we going to have creative new ways of working? Because I think one of the things I've been incredibly impressed with is how our 7,000 employees have really stood up magnificently, I think, to the challenges ahead of them. So we locked down our services 10 days before the national lockdown. We closed our offices. So I've got 350 people who ordinarily work in an office sat at home working in various states. I've had 50 people's day jobs disappear, and they've turned into PPE procurement officers, creators of e-learning for staff about how to put on PPE properly. So the sector, I think, generally has responded magnificently, and I concur with John and Mitesh's comments around how great our staff have been through this. We saw the sickness spike. It's come down again. I think that's been a common factor. Our colleagues just want to get to work and support people. In terms of PPE, interesting, nightmare. I think we're on our 6th set of government guidance. Interesting statistic is our normal annual usage of PPE is £40,000 per annum. Per month, we are now burning through our way through £400,000 worth. So in 1 month, we're using 10 times what we normally use in a year. And that's why that 900,000 from local authorities is quite helpful, but you'll see that it's going to be a drop in the ocean, because I do think that PPE usage is with us for the foreseeable future. I can't quite yet see what has to happen for the government guidance to shift. So I think looking forward, I think there are a number of things I'm really trying to think very carefully about is what state are our commissioners going to be in 6 and 12 months' time? I was talking to a local authority director the other day whose annual budget is the whole local authority's budget, forgive me, is about 750–60 million pounds. Their impact, so lost income and additional cost, they're estimating to be 100 million pounds. And so far, they've got £22 million guaranteed from the government. That's before the latest 600 million. So you can see local authorities are reeling at the moment financially, and without central government assistance, I think local authorities will be on their knees. So how's that going to affect commissioning, etc.? How long is the recession going to last? It's probably the deepest and longest since the Second World War. I read the other day. That's quite a depressing thought. Employment market, the state of the NHS, what's that's going to be like? So there's a whole raft of things I think that are going to shape the future, and we're trying to get our head around what they look like. My last point, Henry, before I hand back to you, is I think there's a real question as to whether social care is going to continue to be seen as one homogenous lump with the same policy framework. I do think it's quite conceivable that the older people's market is going to have a very different policy framework going forward than our sector. And I think that will be an interesting dynamic to maybe explore. That's it.
Steve, thank you very much indeed for that. And that last point's a really interesting one, because I think in the elderly care markets, obviously by value, more than half of it is a private pay market. So they're genuinely consumers exercising consumer choice. Whereas in adult specialist care, they may be consumers, but it's not out of choice, and the government is paying their bill. And I think there's a big difference there in those two. But I think my takeaway from what you've just said is really just to re-emphasize one of those themes we've had from the beginning, which is the resilience of the sector, the fantastic performance of the staff who've stepped up in an amazing way under significant pressure, having not necessarily had the support from government or the access to PPE that the NHS has had. I'm delighted to hear you have a more positive view about the outlook for social care and the opportunity to reform, because I think there really is a window to make something happen here. And it ties in also with what Mitesh was saying about supporting things like the care badge, Sparkle for carers, etc. And even on local authorities, I'm very glad to hear that a number of them have been supported with additional funding at a time where people are incurring those significant cash costs around things like PPE. Although bearing in mind the bureaucracy that you've also seen, and actually just the fundamental challenge of the maths that local authorities have in terms of the money they have and the costs that they're incurring, it's going to be a very, very difficult sum to solve over the next 2 to 3 years. With that background, I get a hand over to Peter, and I would just say to the panelists again, just to remind you, any thoughts on Wales or Scotland are also welcome as we try and make this a national perspective. But Peter, over to you to talk about it from Grant Thornton's perspective.
Thank you, Henry. By way of introduction, I lead the corporate finance healthcare team at Grant Thornton. And as I go through the investor focus and outlook, I will show why specialist care is a core focus for us and why it will continue to be so. So to cover the investor focus, I wanted to answer sort of 3 questions. Firstly, what the investor themes were pre-COVID-19. Secondly, how COVID-19 has impacted this. And then finally, what the current investment activity is, what's still happening, and when it will pick back up. So if I move on to the first slide, then pre-COVID-19, what were we seeing? We were seeing a more diverse investor base. There were infrastructure funds, property funds, private equity funds entering the space and it was becoming a more mainstream investment class. It was becoming viewed as core social infrastructure, long-term placements, protected funding, high acuity focus, barriers to entry due to challenging conditions and lack of suitable beds. And there was a number of consolidation drivers at play, a very fragmented market, increased specialism, recruitment challenges, a challenging regulatory environment, tech developments, requirements for a full care pathway. And so it's harder for some of the smaller operators to keep pace with the changing environment. Coupled that with a CQC regulator focus, which continues to be on some of the larger units, a transforming care agenda, trying to get the high acuity patients and service users out of the larger units and into smaller community settings, and the previously residential care service users into supported living settings and moving down into more into community. And then on the commissioner side, that also supporting that supported living focus, partly driven by access to central government funding. There has also been a kind of a blurring of lines between some of the elderly care and the specialist care segments, with particularly some of the dementia with challenging behaviours now being undertaken in sort of a more traditional elderly care setting. So moving on to the M&A that we saw previously, and this is just to capture some of the key themes. We saw a lot of activity from the infrastructure funds, AMP, ICON and Antin, making their first forays into core plus infra. And more interestingly, recently, Ankala going into homely care. And this was very soon after lockdown, so very recently, a deal that has happened during the coronavirus outbreak. And it is a deal which is below the previously perceived thresholds of infrastructure funds, and a deal of sub 50 million size. So infrastructure funds are coming in at a potentially lower level. We also see private equity continuing to make a lot of acquisitions. Particularly of interest is Salutum's acquisition of Scopes Care Services last year, an acquisition of a charity provider's care homes. We've seen a lot of activity from propcos, particularly Civitas, who've been the most active property investor, deploying over 900 million in the last 3 years and looking to deploy a similar amount over the next 3 years. This has also prompted the opco market to emerge, and there's a number of providers that in specialist care that are just opcos. And then finally, we're seeing kind of the larger trade not being quite as active as they have been previously. Some of them looking at the horizons around what their next stage is going to be. So if I move on to how COVID-19 has impacted this outlook, so I think it reinforcing a lot of the comments that the operators have made so far is that the sector's held together well. And it's proved to be very resilient. It hasn't been as badly impacted as elderly care. It's demonstrated it's part of the critical infrastructure. I think care workers are starting to get the recognition that they deserve. And I think the sector's received more operational stress rather than financial stress. And some of those challenges that was leading to consolidation previously are even more prevalent, e.g. sourcing PPE, recruitment, working policies, and adapting to the new world. So overall, it's really proving how robust it is in an environment where investors are seeing really challenging situations elsewhere, and it's now receiving even more focus from investors as a safe harbour or a more defensive asset class. So we are seeing renewed appetite from investors that were previously not focused on the sector. So will it emerge stronger? It could be, the funding question is at the forefront of everybody's minds, but it may be more appreciated by society. The workforce may be more highly regarded, and there may be more workers to recruit from. So what is currently happening? So Obviously challenging times, particularly for an M&A environment, as people focus rightly on the operations, but there are a number of live deals that continue to progress. We're finding new ways of working remotely, virtual site tours, remote property surveys, virtual management presentations, and virtual diligence. Property funds in particular, and Civitas is still very active, closing the Vision MH deal recently, and still looking to deploy. And the performance on the stock market, it's the best performing REIT on the London market this year, with 99% of rents collected. And there are a number of assets that were lining up to come to market later in 2020 that we still believe will do so. So when we're already having a lot of those conversations with investment funds that are looking to refocus on specialist care, so it will get the support that it needs. Key factors to be determined though around how quickly it will come back, particularly will be about the banking and debt fund appetite and how quickly they will respond, around the speed they will come back in and the leverage they will be able to put in and the pricing. That's yet to be determined. And then finally, on the infra fund side, it's will it be traditional infra assets not faring so well? Will core plus become the new core, or will infra retreat back to core? I think it's more likely to be the former, and we're likely to see infrastructure funds here to stay.
Peter, thank you very much indeed for that. I think we've now got about 10 minutes left to go to the Q&A. So again, if you're logged into Slido, you can ask your questions and you can own up to who you are, or you can do it anonymously. You can vote questions up, and you can also participate in the poll, which should be running in the background. So if I can just get this to work, that's the poll where funding is currently in the lead as the biggest headwind, with sector profitability and higher costs at 30% each. But if I go to the Q&A, I'm going to start with bundling two questions together here, which are more of an operational one. The first one relates to technology. And actually, Mitesh was very good in laying out how they have adapted in terms of home working, in terms of recruiting people, onboarding people remotely. But it'd be very interesting to hear from John and Steve how that's also been affecting their businesses. And Steve alluded to some of it already with the remote working of 350 people in central office. But in some ways, some of this is sort of existing technology. Are there other things that the sector can look forward to from a technology perspective, which partly might be because the regulator allows things to happen now that they wouldn't have done, and partly because people are now used to doing things and can see they can do things differently, which perhaps they hadn't done before. And then I was going to roll this into the second operational one, which is around social distancing. How can adult specialist care providers comply with social distancing? So two operational things. One is use of technology, and the second is how are you managing this guidance around social distancing with the practical challenges of actually doing that in your home. So John, can I go to you first and get your perspective on those two?
Yeah, sure, Henry. I think the story at Exemplar sort of tracked roughly the stories from Mitesh and Steve, the core central employees working straight away from home pretty early on, which we did, and then we already had all of our homes were equipped with Wi-Fi. We moved out tablets, 2 or 3 tablets for every home, primarily to allow them to communicate with their families, because we shut down all contact very early on with relatives and families, for the safety of the service users and staff. We've also have electronic signing in tablets, which was not meant for the purpose we ultimately use them for, but in the early days of high absence, we managed to be able to track. In fact, I've got an app on my phone that tells me in real time that I've got the necessary staffing in every home. So, and I mean, I say real time, it is linked into these tablets that are in the receptions of all of our homes. So we've sort of moved swiftly into looking at the infrastructure we've got, the IT infrastructure we've got, and really developing it pretty fast. So you know, even some service reviews of the homes can be done via Zoom, and all the staff are getting pretty well equipped to communicate in that way. So it's I think remote working and non-invasive communication with homes has been where technology has been at the forefront from us. Thinking your point about the question around dealing with the contact, the physical contact element and PE in the homes, etc. This hasn't been a major issue. I think fundamentally, have 30 staff in a 30-bed home who are walking up and down corridors on units. What we've obviously tried to do from the go was to restrict the movement within the unit. So we've had a smallish home actually, which had the virus, but only on one floor, and we contained it there, and he didn't go to the ground floor. I think there is going to be physical contact with our staff and our service users. You can't avoid that. And so you can take as much as the precautions you possibly can with PPE, and we do, and we are well staffed as a company, so we don't have stretched staff to service user ratios, which does allow us to manage our service users at extreme periods in a safe way.
Thank you very much for that, John. And Steve, just to get your perspective on it as well, briefly.
Okay, sure. A couple of comments on the information technology. I think one of the most interesting things that's happened in the organisation is how we have stepped up with the production of meaningful management information. So we now have daily information, which is live, which I hadn't really thought we would be able to do anywhere near as quickly as we have. And my board of trustees have access to that as well through Teams. That's given them significant assurance about how we are managing the risks. So that's been a really positive one. Every single process is now technology driven. So the most interesting one, I think, is we now do disciplinaries and dismiss people on screen, and we have a union recognition agreement with Unison. So that's a real issue. That's a real step forward. And staff usage is non-negotiable. So I really think it will be very difficult to turn the clock back. My fear is how some of the bureaucrats and regulators and commissioners outside the organisation, whether they are going to be as willing to continue to accept the type of usage of technology moving forward. Is a question we're grappling with, I think. In terms of social distancing, that's a real bit of a frustration for us. I mean, we work in England and South Wales, so we're now subject to different rules, as it were. That's an interesting challenge we are grappling with since the weekend. What issue we're noticing is that our staff aren't always adhering to the guidance. So we got some wonderful VE Day celebratory photos, but not one staff was wearing a mask, and they should have been, because they were within 2 meters, etc. So there's a real issue for us. And I think what really brought it home for us was the number of RIDDOR reports we've done to the HSE, and having to make sure that we are putting in place the right equipment and getting the staff to comply. So that was some interesting thoughts, maybe. Okay.
No, thank you very much for that, Steve. Mitesh, there's one question here for Precious Homes. Why were Precious Homes asking service users to wear PPE if no one had been infected by COVID?
It wasn't the service users who were asked to wear the PPE, it's the staff that who have to wear it, and that's the government guidance that we were following. So it wasn't the service users, it's actually the staff members who were supposed to wear it as part of the government guidance. And clearly some of our service users were not impressed with our staff wearing them. So yeah, that was the issue. Very
good. Peter, I've got a series of questions for you. Dassos Kestides has asked a question about, other than providing more capital, what else can the banks do? But I think tied in with that, there are a couple of questions around how people are diligencing transactions remotely. And I think there was one particular challenge. I was talking to one of the valuers saying that their insurance doesn't actually allow them to sign off on a valuation often unless they've had a site visit, or at least a recent site visit. If there's no valuation, the bank can't lend against the asset. So whilst you mentioned you've got 5 deals that have gone live, it'd be very good just to get your take on how, from a diligence perspective and also from a funding perspective with the banks, we can actually work around the pandemic.
Yeah, thank you, Henry. So from the diligence perspective, we are managing to do a lot of the work remotely through videos that the owners or care home managers are being able to take going around the homes, and some of the valuers have been able to work out ways of, or surveyors of conducting the surveys in that way. It's obviously not ideal, and I think as soon as we get more access, that will be or working out ways of trying to do that, obviously without accessing homes unnecessarily. So there's a very fine balance with that, but it is a challenge that is having to be worked around, definitely at the moment. And on the banking point, on Dasos's question as well, in terms of what else the banks can do, I think it's trying to understand what the liquidity challenges are, what the funding challenges are, and trying to work collaboratively with the businesses and the operators to deal with those. As we said earlier, at the moment, it's operational stress rather than financial stress that we're seeing in a lot of the providers. And I think the question around sort of debt funding for transactions going forward, I think that this is one of the key questions that we're going to have to see coming out of this. How, understandably, a lot of the banks at the moment are mainly dealing with existing customers' requirements rather than looking at new business. But there are a lot of debt funds, and there was a lot of debts available pre-COVID. So as we work through this, seeing what that debt appetite and how quickly that comes back will be a key factor in transactions and how transactions are structured.
Very good. Thank you very much, Peter. William, there's a question around whether we think the value of specialist care facilities and by implication the whole market will increase. So if I let you think about that for a few minutes, I was going to cover off first 2 of the other themes that are coming through. One is around funding. We've heard about the 3.6 billion, we've heard about the 600 million. And actually, Steve, you were saying that some local authorities have been actually pretty responsive around some of this additional costs. If your PPE costs have gone from 40 to 400,000 pounds a month, or 40,000 a year to 400,000 pounds a month, I guess the question is, it's probably difficult to give a simple answer because it's local authority by local authority. But are providers seeing some of that money come through? Are local authorities acknowledging that you have increased costs? And actually, the other big question is, we've got this significant 6.2 increase in national minimum wage. Is that getting lost in the noise, or are you seeing fee uplifts that reflect the true cost of operating? And really, if I start with you, Steve, and then Mitesh and John, it'd be really good to get each of your takes on that.
Okay, in terms of uplifts, we've probably had our best year for uplifts. We're on budget already for where we were budgeted to be for this year. So it's obviously not uniform across the board. So we have found local authorities generally to be more aware of and accepting of the cost pressures in terms of the national living wage, etc. So that's been okay. In terms of COVID stuff, as I said, 60 out of 92 have responded positively. About half of that 60 have given us a grant based upon a percentage of our contract value, ranging from 2% to 10%, and that's usually they've offered it for the first quarter. We have had some one-off ones. So yeah, that's where we are in terms of money.
Mitesh, if I turn to you, because you mentioned you're sort of Birmingham down to London, you'd be exposed to a slightly different universe of local authorities.
Well, similar. Well, we haven't been as successful in terms of getting the sort of annual increases. I think we're sort of 50% of the way there in terms of what our target is to keep the margins where they are currently. So yeah, we're halfway there. And in terms of PPE and any sort of funding for that, we've had some letters from local authorities saying they will give us some money for the COVID-related PPE. Some have asked for spreadsheets. So it's a mix of stuff. We haven't actually seen any money come through yet, but we need to process that sort of PPE funds that are there.
And John, with you, where you've got some very vulnerable people with extremely high average weekly fees, is there an acknowledgement from any of your funders around both national minimum wage uplifts, but also these PPE operational costs?
Issue for us, and I guess for the other guys, is the varying responses. So it's cross funding every year from those that do what I would say is the right thing on the uplifts and those that don't. So we hit our budgeted uplifts each year. We will this year. This year has, as Steve said, has been a better year, but simply really because when you get such an increase like 6+%, you break through what they would call productivity issues. So the worst thing for us is when it's 2 or 3% or 4%, because they just offer nothing and say, well, you're private sector and you should be able to cover that. So I think the size of the uplift has bizarre way helped us to go out there and have meaningful discussions. I think on the PPE, really for all of us, ask us in 3 months' time, because once again, we can't just go to one point of contact and have a negotiation like the NHS and say, right, what's it going to be? I have to have 100 different discussions with authorities and CCG. So we are hearing very good responses from a lot of our funders, and I would say professional responses, recognizing the speed they have to act and recognizing that they can't really be forensic. They should have enough information also themselves to assess what the burden will be on Exemplar or with Precious Homes or whatever. They should be able to gauge what it means for us to do this. It's not a massively complicated issue. When they're responding to us saying, as we have also had, give us spreadsheets, give us service user consumption, that's just crazy. There's no way you can stop and record that. You have to. We can do it by home, but then in each of our homes, I've got up to 12 different funders. So how would you work that out? So there needs to be some sensible decisions made pretty quickly. What I don't want to see is that we go through the same protracted negotiations that we do on yearly uplifts for PPE. I think that would really be a poor outcome.
So I think my takeaway from that is there is an acknowledgement from funders that the significant uplift in national minimum wage plus the cost impact of the pandemic has increased operators' funding, and that needs to be reflected in some way, but we don't yet have clarity on how that's going to play out, because it's a whole series of separate negotiations with each local authority. But there is an acknowledgement that pressure there, which at least is a positive starting point.
Yeah.
So just coming back to you, William, and just the value of the sector, given what we've heard about effectively a top line that's holding steady, but perhaps some margin pressure, what do we think is the outlook for the sector over the next year or two?
Well, I think in the medium to long term, I think the value will increase because the funders are responding to a certain degree anyway. I think this is true across the whole social care sector, not just adult specialist care. As far as the values of the assets themselves are concerned, I mean, they tend to increase with inflation, provided the margins do not suffer too much. They also depend, of course, on the multiple, the enterprise value to profitability multiple, provided the government doesn't throw the investor to the wolves, as it were, by simply not responding at all to the excess cost pressures in the future, then that should be okay as well in the long term.
Very good. I'm just going to wrap up with two more themes. One is around the investor market, and this is one for you, Peter. Do we think that with the debt markets in disarray, that private equity will actually start looking opportunistically at equity-only deals and maybe bridging it to a refinancing? And is there also any sign of people looking for distressed assets as well? I don't know if you've got any thoughts on that and whether you're seeing any activity around that.
So on the private equity side, yeah, that's definitely an option and something we may well see with private equity looking to sort of equity underwrite. But equally, you know, there's a lot of private equity funds that have vehicles already that they're looking to consolidate from or bolt on to, that have committed facilities or existing banking arrangements in place. So and that, you know, the debt from that existing facilities could still be and should still be available. It's mainly for the platform deals where it would be a new relationship, and even then, the private equity funds tend to have good relationships with particular lenders, and that may well still be an option, or it could result in more creative deal structuring requirements, and as you say, a refinance subsequently. So I think that there are a lot of options available at the moment. And on the distressed investor side, it's still quite early. I mean, it's something that we are starting to see around opportunistic investors and appetite there, but we haven't seen those opportunities starting to come through yet.
Thank you very much, Peter. We've got 3 minutes left. So the last question, I'll wrap a couple of them together. I think it also goes to how local authorities are actually going to have to solve this challenge of effectively the demands on the more limited amount of cash that they have. Do we think commissioners will try and push service users into cheaper alternative settings? So 10 people have voted for that question. So it's clearly one that is at the forefront of their minds. And then the second one is, will staff recruitment and retention improve significantly post-COVID? And that's really linked also, I think, to raising the status of social care among the broader public, among other things. So Mitesh, can I start with you? And I think it's literally 30 seconds to give your thoughts on that.
Sure. I think on the recruitment front, absolutely. I think the profile has certainly been raised. We are getting a lot more inquiries generally now, and I'm very confident, you know, especially with stuff that's happened in the hospitality and leisure industries, a lot more people will be coming through to social care and healthcare. So yes, there's definite opportunity there. Sorry, the second part of your question was?
Do you think commissioners will push people into lower cost settings?
I think there's always that push, and clearly they've got budget, so that it will be tight, so they will try and push that, but it's just how you resist it and demonstrate the quality of what you're delivering.
Okay. Steve, do you want to comment on those two?
Yep, okay, recruitment. Absolutely. I don't think recruitment's going to be a challenge for a while, if we're being perfectly frank. Social care has always benefited from recessions, and I don't see that changing. In some areas of the country, we're no longer recruiting because we have no staff vacancies. I can't remember that ever happening before. And cheaper providers, yes, if you can't evidence the value and impact of your offer. I think there will always be a demand for high quality, high value services.
And John, finally to you to wrap up.
Okay, with what the other guys have said, Mitesh and Steve have said, I would just add, I think with an outlook of a recession and difficult, economics, I expect recruitment to stay very, very strong in a what is ultimately a government-funded enterprise that we all run. And I think the other question was?
Pushing people into lower cost settings.
Yeah, I'm with Mitesh and Steve on that one. Ever thus, I think the point is the amount of care that someone needs is the amount of care someone needs, and ultimately they will end up in the right home.
Well, look, thank you all very, very much indeed for your contribution this morning. I think we've covered a lot of ground. There's clearly some common themes there, but I do think this part of the market has been remarkably resilient. And that may be as much through luck as anything, just given the profile of your service users and the services you provide. but I also think that puts it in a very strong position to bounce back strongly. So thank you very much to Grant Thornton for partnering with us on this. There is a coronavirus toolkit, as I mentioned, on the Langbuisson website, and this whole webinar will be available with the slides and a download of the video. And there's an opportunity for you to make a donation to turn to us when you view it. But I think from my side, again, thank you to the panelists. And then finally, our next webinar will be next week, which is going to be on risk and liability in partnership with Marsh and DAC Beechcroft. So Marsh, an insurance broker. I think a lot of operators are looking at business interruption risk. They're looking at the risk from a liability perspective as directors, as they have staff going in to deliver services, perhaps not always with the right PPE. There's an awful lot of legal uncertainty around this sector. So again, thank you all, and we may see some of you next week. Bye.